Part 2, mortgage madness, bailout bullshit, the meaning of money. I gave an example of a bank making a loan to somebody who operated taxis. Why is this loan a good loan? If there's a demand for rides and taxis, then the driver, the owner, will earn something over and above the cost of the taxi and the operating of the taxi. If you're doing something for people who have worked and earned and therefore had purchasing power, and they want to buy something from you, then you're doing something good for them. That's productive. That's what the economy is about. And the bank loan, which is made at 8%, means the bank takes a certain portion of whatever is earned by the capital good, by the taxi. The person who operates the taxi uses that. So in a sense, the taxi earns something a rickshaw couldn't earn. And so the bank takes 8%, let's say the owner, the person who made the loan, gets something like a 10% return. And of the 8% that the bank keeps, 3% goes to the saver. The saver is not capable of finding someone to lend out to and to be assured that there's a good chance the loan will be repaid and that the money won't be lost. If the bank is doing its job, it will find customers who can make good use, can do something economically useful, and they get a portion of the return from whatever the money is used for, and splits it with the depositor. The depositor has FDIC insurance. That is, the money, if the bank goes bust, the deposit won't be lost. The depositor will be repaid. So that's worth a good bit. And 3% interest out of 8 is not bad. And the bank takes the loss. If they make a loan, the taxi driver splits, doesn't repay it, can't make money with it, wrecks the taxi, doesn't have insurance, then they still have to make good to the depositor, and they have to use whatever they make from good loans to offset the loss. Okay, that's the way it's supposed to work. So if you save, you earn, and you want to store it, that's one way to do it. Commercial paper is an IOU issued by a company in return for a short-term loan, and it pays interest. And that replaced bank loans among larger companies that had good credit, that had robust businesses, like General Electric, and at one time General Motors. So they could borrow in the commercial paper market, borrow huge sums, and pay a lower interest rate. And so the investment banks sold their paper. They're the ones who developed these markets. And so this was just something that meant that businesses could borrow from people willing to lend to them for productive purposes, but at a lower interest rate. Now, what the money supply is supposed to do is to permit people who are capable of engaging in real economic activities, that is, do stuff that other people need, and have them do stuff that they need. The money supply makes it convenient to trust people and therefore engage in a higher level of activity. So over time, the money supply increases in economies where real capacity to produce is getting great. greater. And the Fed generally purchases securities in the open market and creates new money, thereby exchanging an old security, an old bond, for newly created money, and then the person selling the bond then has to find a borrower. And so that encourages lending for real economic purposes. And so if you have a society where a high level of investment is desirable, and that's really any society, because investment is using resources to create tools that make people more productive, like a taxi versus a rickshaw. When IOUs proliferate and can be traded rapidly, there's a tendency for people to see these IOUs as something very close to money. I mean, if you only hold it one day, it's almost like money. I trade on my niece's account. This is her entire net worth. It amounts to about $250,000. On Thursday, October 9th, I had her 10% in stocks, 90% in cash. Friday afternoon, after what seemed like an endless decline in share prices, I had a hunch that there might be an upturn. And in the last hour of trading on Friday, I put her about 30–40% in stocks. That is, I purchased for her account about $75,000 in stocks. And then Monday morning, another $100,000. And then by Monday afternoon, I had sold some and bought some more Tuesday morning, and then sometime during Tuesday sold that. And by Wednesday, she was back to 10% in cash. So I had engaged in transactions that, when you total them up in about 16 hours of trading, amounted to like $800,000 in an account that only had $250,000. And there's a 3-day time period before settlement of accounts. So her account is with Fidelity, and any cash that's laying in the account sits in a money market fund. So Fidelity lends it out and gives her some of the interest to municipalities, and then takes it out, and then it goes into stock transactions. And at the bottom of the page it said money owed by other people to that account, money the account owes to other people, because before the 3 days were up, I had turned the account about 3 times. And so whatever actual cash was tied down in this account, was not being lent out or awaiting movement, was small compared with the total value. That is, a couple, $100,000, which might have been sitting there at any given time, turned over about 8 times in transactions. And during that time, she netted about a profit of about $25,000, about 10%. And nothing productive was done. I mean, this was just a game I was playing on her behalf, because these transactions could take place so rapidly, online, and with so little cash being tied down. So, when you have money moving around in financial transactions, which involve nothing useful being done, no benefits to people unless they're gamblers, then it can move around very, very rapidly. And that's what happens in the modern economic system. In part 3, I'll deal with the bailout plan and the mortgage significance.